Welcome to Market Pulse by Resties Capital, your daily briefing on the key market moves, macro developments, sector trends, and investment themes shaping the day. Today is Friday, May 8th, 2026. I'm Marcus Lead Anchor, and joining me is our senior market strategist, Elena.
Great to be here.
So I want you to imagine staring at this gleaming, ultra-modern skyscraper. The construction crew is just operating at lightning speed, adding brand new top floors, installing state-of-the-art glass. And the building just keeps reaching these unprecedented record-breaking heights.
Right.
But if you look down at the ground level, the concrete foundation is literally fracturing under the weight.
Yeah, that's the exact paradox lighting up institutional trading screens this morning. The divergence between asset pricing and actual macroeconomic reality has just reached this historic extreme.
It really has.
We are operating in a highly bifurcated environment right now where traditional market rules are, they're temporarily suspended.
Yeah, and our objective today is to synthesize this massive influx of proprietary dealer modeling and macro data for you. We want to decode the mechanical drivers beneath this surface and, most importantly, identify how professional capital is positioning for the quarter ahead.
Exactly, because before we get blinded by the shiny surface of equity indices printing all-time highs, we really need to inspect that fracturing foundation you mentioned.
Right, which starts with the macroeconomic plumbing.
Yeah, specifically the structural tension between labor market resilience and just incredibly sticky inflation.
Well, if you just glance at the top-line numbers, the foundation looks robust, right? The April Non-Farm Payrolls report just printed an addition of 115,000 jobs.
Yeah.
Which completely shatters the consensus expectation of, 65,000.
Right, it does. And a superficial reading of that print would suggest undeniable economic strength. But institutional commentary and proprietary models reveal a notably cooling labor market beneath the hood.
So what's the actual metric professional capital is focused on, if not that headline beat?
Yeah. It's the break-even job growth rate. So this is the baseline number of jobs the economy needs to generate monthly, simply to keep the unemployment rate stable, adjusting for population growth and labor force participation.
Got it. And historically, that break-even number hovers around 100,000 jobs a month, right?
Historically, yes. But we have demographic shifts, an aging workforce, and frankly, the very early phases of AI labor displacement altering that baseline entirely. Major dealer desks are now projecting that this breaking rate is going to fall to just 50,000 by year-end.
Wait, 50,000?
Yeah, 50,000.
So a headline beat today is actively masking a structural softening.
Yeah.
The market is cheering a number that in reality reflects an underlying engine that's running out of steam.
Exactly. And if the underlying economic structure is softening, traditional monetary logic dictates the Federal Reserve would be gearing up to cut rates, right, to stimulate the economy.
Right. But they aren't.
No, they aren't. Institutional consensus has officially pushed back the forecast for the final 2 Fed rate cuts all the way to December 2026 and March 2027.
Wow.
Yeah. And we are looking at a terminal rate stuck at 3 to 3.25%. The Fed is completely paralyzed here.
And the primary driver keeping rates elevated is persistent core PCE inflation, right?
That's the one. Personal consumption expenditures. It's the Federal Reserve's preferred inflation gauge because it tracks how consumers dynamically change their buying habits when prices fluctuate.
Right. They switch from beef to chicken if beef gets too expensive, that sort of thing.
Exactly. And normally, core PCE strips out volatile food and energy prices to give a clear view of underlying inflation. But right now, the current core PCE is being artificially propped up by an aggressive energy cost pass-through.
Okay, I have to push back on the Federal Reserve's logic here for a second. If energy supply shocks are the main culprit, specifically the geopolitical tensions in the Strait of Hormuz keeping oil elevated, isn't the Federal Reserve effectively being held hostage by global events?
Yes, absolutely.
It feels less like they are utilizing monetary policy to cool a boiling domestic economy, and more like they are trapped by external conflicts thousands of miles away.
The Fed is absolutely cornered by external shocks, and that is the defining debate on institutional trading floors right now. The issue is that the Fed's mandate is domestic price stability.
Right.
So when an external shock like elevated oil prices persists, it doesn't just make gasoline expensive. That energy cascades through the entire domestic supply chain.
Because everything has to be shipped.
Exactly. Logistics companies raise their rates, manufacturing inputs like plastics become pricier, and eventually the cost of everyday consumer goods is forced higher. So, to prevent those external price spikes from becoming permanently embedded in domestic inflation expectations, the Fed is forced to keep global rates under hawkish pressure.
Regardless of where the inflation actually originated.
Exactly.
And that hawkish pressure is severely impacting the Treasury curve. I mean, looking at the institutional research, professional capital is hunting for shelter, and carry trades are emerging as the massive focal point.
Yeah, they are.
The 5-year part of the U.S. curve seems poised to significantly outperform during periods of market consolidation. Can you walk us through the physical mechanics of why that specific segment is the sweet spot right now?
Sure. So a carry trade involves borrowing capital at a lower interest rate to invest in an asset that yields a higher return, allowing the investor to pocket the difference, which is the carry.
Right.
Right now, the very front end of the yield curve is highly erratic. It's reacting violently to every daily headline regarding inflation and Middle Eastern geopolitics.
It is nerve-wracking.
Very. And conversely, the long end of the curve is vulnerable to structural questions about massive long-term government debt issuance. So the 5-year segment, often called the belly of the curve, offers this optimal risk-adjusted balance.
It provides an attractive yield without taking on the extreme duration risk of, say, a 10-year or 30-year bond.
Exactly. Institutions are flocking to the 5-year to generate pure carry while insulating themselves from the volatility at the extreme ends of the curve.
Okay, so if the Federal Reserve is paralyzed and rates are entrenched in a higher-for-longer reality, it defies all conventional logic that the equity indices are doing what they are doing.
It really does.
I mean, the S&P 500 is sitting at 7,398.93. The Nasdaq is at a staggering 29,235.00. We are hitting record highs in a high-rate, high-inflation geopolitical minefield.
Yeah, and unpacking that requires looking at a fundamental regime change in corporate capital allocation.
Yes, can do it.
First quarter earnings were objectively robust, tracking at 17% year-over-year EPS growth.
Which is huge.
It is. But the metric that institutional research is absolutely fixated on is the historic pivot in how corporate cash is actually being deployed. First quarter capital expenditure CapEx grew 38% year-over-year.
38%.
Yeah. That completely eclipses share buyback growth, which clocked in at a microscopic 1%.
Wow. 38% CapEx growth versus 1% buyback growth. For the last decade, financial engineering and relentless share buybacks were the primary engine of equity returns.
Right.
And now, companies are drastically pivoting away from buying their own stock to pouring cash into physical infrastructure.
Yeah, but the concentration of that spending is extreme. This is not some broad-based economic reinvestment. It is driven almost entirely by AI hyperscalers.
Just a handful of massive tech firms.
Exactly. These mega-cap technology firms are projecting an astounding $755 billion in CapEx for 2026 alone.
$755 billion.
Every available dollar of free cash flow is being redirected into acquiring physical semiconductor chips, building advanced data centers, and securing the industrial energy infrastructure required to just power those centers.
Which brings us right back to the critical vulnerability in that skyscraper analogy. Outside of those hyperscalers, dropping $750 billion on infrastructure, the rest of the market looks incredibly fragile.
Very fragile.
Institutional research just flagged a violent unwind in high beta momentum stocks, an 8% single-day drop.
Yeah, that was brutal.
It ranks as one of the top 10 largest unwinds in the last 5 years. And at the exact same time, consumer discretionary names are openly reporting an April slowdown as everyday shoppers just pull back.
The breadth of market leadership has narrowed to a precarious degree. High beta momentum stocks are, the high-risk, high-reward equities that typically fly highest during economic booms.
Right.
An 8% single-day unwind means institutional algorithms aggressively dumped risk. When you pair that institutional de-risking with consumer-facing companies reporting weakening demand, the fracture in that macroeconomic foundation becomes undeniably clear.
So we have unprecedented CapEx spending from a handful of tech giants, masking the weakness in everyday consumer spending. But to truly understand how the indices are mechanically staying afloat despite the high beta unwind, we have to examine the derivatives and credit plumbing. The volatility data is doing something highly irregular right now. We are seeing a spot-up, vol-up dynamic.
Which completely violates the most basic axiom of options trading. Normally, when the stock market rises, when the spot price goes up, market fear subsides, and the cost of volatility, measured by the VIX, goes down.
They historically move in opposite directions.
Always.
But despite this massive equity rally hitting record highs, the VIX actually ticked up to 17.19. The demand for protection is rising parallel to the market. Why is the fundamental plumbing breaking down like this?
The answer lies in dealer gamma positioning, which is currently running extremely short, particularly in the Nasdaq.
Okay, break that down for us.
To understand this, you have to view market makers, the dealers who facilitate options trades sort of like a casino bookie. They don't really care which horse wins the race. They simply want to collect the transaction fees. However, because investors have aggressively loaded up on call options to chase this AI rally, the dealers are the ones who had to sell those calls. And by selling those calls, the dealers become short gamma.
This sounds like an algorithmic snowball effect.
Mhm.
What are the physical mechanics of what a dealer has to do when they are short gamma and the market starts rising?
Well, when a dealer is short gamma, their risk exposure accelerates exponentially as the market moves against them. So, if a dealer sold a massive amount of upside calls and the Nasdaq starts rising, the dealer's financial exposure becomes increasingly negative.
They're losing money.
Right. So, to neutralize that risk, to flatten their book and stay perfectly hedged their trading algorithms, force them to go into the open market and buy the underlying stocks or index futures.
Ah, so the market ticks up, which triggers the dealer's algorithm to buy more stock to cover their risk. That buying pressure pushes the market even higher, which forces them to buy even more stock.
Exactly.
It creates a perpetual motion machine.
It is a continuous mechanical squeeze higher. And this is the crucial takeaway regarding equity valuations right now. The buying isn't happening because a fundamental analyst upgraded a stock based on improving cash flow projections.
Right.
It is a mathematical imperative executed by a hedging algorithm. It completely detaches index pricing from macroeconomic reality.
And while that mechanical gamma squeeze dominates equities, the credit markets are flashing distinct warning signs of their own. Non-financial commercial paper issuance has just hit all-time highs.
Yeah, and it's heavily concentrated in the energy and utility sectors.
Right. So commercial paper is essentially a short-term unsecured IOU issued by corporations to cover immediate expenses like payroll or inventory.
Yes.
The reason energy and utility firms are issuing record amounts of it ties directly back to the geopolitical conflict in the Middle East, doesn't it?
It absolutely does. The disruptions require these firms to rapidly reroute physical supply chains and execute massive hedging operations against sudden oil spikes. They are tapping short-term debt markets to maintain the deep liquidity required to just finance those operations.
And across the Atlantic, European investment-grade credit valuations are screening as highly expensive. The institutional strategy over there is rapidly shifting away from betting on spread compression and moving toward pure carry generation.
Right.
For those navigating fixed income right now, differentiate those two specific approaches.
Sure. So spread compression occurs when the yield difference, the spread between a risky corporate bond and a safe government bond, shrinks.
Right.
If you buy a corporate bond and the spread compresses, the price of your bond goes up, generating capital appreciation. But currently, European corporate bonds are so expensive that the spread is as tight as it can realistically get.
So there's no upside left.
Exactly. Institutions recognize there is zero room left for the price to appreciate. Therefore, instead of betting on spread compression, they are shifting to pure carry generation.
Meaning they are buying the bonds solely to collect the coupon yield.
Exactly, accepting that they won't make a profit on the underlying price of the bond itself.
Fascinating. So we have a Federal Reserve trapped by energy-driven inflation, an options market forced into mechanical buying loops, and credit markets maxing out on valuation. Synthesizing these elements really crystallizes the dominant narrative of today's trading environment.
It does. Institutional consensus has formalized this theme as fragile optimism. It's a delicate balance underpinned almost entirely by what dealer desks are calling the AI anchor theory.
The A anchor theory. That aligns perfectly with our skyscraper analogy. The entire structure, despite a fracturing foundation, is being anchored by a single massive weight.
Precisely. The brute force of AI infrastructure growth is serving as a massive structural counterweight. The physical capital flows are so immense, like we said, approaching $1 trillion, that they are effectively overriding the traditional macroeconomic deterioration.
Because in a standard cycle, a buckling consumer and an 8% momentum unwind would instantly trigger a broad, aggressive sell-off.
Right away. But right now, the AI anchor is so heavy that it is preventing the market from drifting into recessionary pricing.
Okay, so if you are managing professional capital in an environment characterized by fragile optimism, the margin for error is non-existent. How are institutional asset managers actually positioning their portfolios for the quarter ahead?
The prevailing institutional guidance mandates a strict barbell portfolio construction. The middle ground is incredibly dangerous right now. Portfolios must be bifurcated into aggressive, secular growth on one end and impenetrable defense on the other.
Let's examine the aggressive end of the barbell first, side A. Analysts are heavily overweighting halo industrials.
Yeah, HALO. That stands for heavy assets, low obsolescence.
Okay. These are the companies physically building out the future. The manufacturers of industrial power grids, advanced liquid cooling systems, and the owners of data center real estate. You pair those halo industrials with direct AI infrastructure plays.
Because this side of the barbell catches the direct tailwind of that massive capex explosion we discussed earlier,
Exactly.
which leaves side B as the defensive ballast. Where are institutions finding shelter if the consumer is buckling and credit spreads are totally tapped out?
The primary directive is that investors must not reach for junk yield. The macro environment is far too fragile to take on lower-tier credit risk right now.
So what's the alternative?
Defensive quality. That means targeting software firms with exceptionally high recurring revenue enterprises that receive subscription payments regardless of broader consumer spending trends. You also want to hold select money center banks whose balance sheets are fortified enough to thrive in a deeply delayed rate-cutting cycle.
Now, I am looking at consumer discretionary assets in this context, and I have to challenge the traditional buy-the-dip instinct.
Historically, when consumer names take a beating, professional money swoops in to buy the discount in anticipation of a rebound. But given the market's current demand for absolutely flawless execution, are consumer discretionary assets essentially dead money for professional portfolios right now?
Broadly speaking, yes, they are. The market is ruthlessly punishing any earnings misses or downward EBITDA revisions in the consumer space.
Because the consumer's tapped out.
Exactly. With real wage growth heavily squeezed by sticky inflation, there is zero patience for a turnaround story. Broad consumer discretionary is largely viewed as highly dangerous capital allocation for the immediate future.
Good to know. But holding defensive stocks doesn't protect a portfolio from a violent shift in the yield curve, which brings us to active hedging. To manage the right tail risk of rising yields, the scenario where inflation forces rates even higher. Institutions are structuring payer options utilizing 3 to 6 month expiries on 2 to 5 year tails. Let's translate that into physical mechanics for everyone. What exactly does it mean to structure a payer option on a tail?
Okay, so a payer option or payer swaption is a derivative contract that gives you the right to pay a fixed interest rate and receive a floating rate. Essentially, it acts as insurance that pays out if interest rates rise.
Got it.
The 3 to 6 month expiry is the lifespan of the option itself. It covers the immediate uncertainty of upcoming inflation prints and geopolitical shocks over the next few months.
And the tail?
The 2 to 5 year tail refers to the underlying asset the option is based on, the 2 to 5 year swap rates.
Okay, so you are buying short-term insurance that specifically protects you against a spike in medium-term interest rates.
Exactly. And on the equity hedging side, the strict guidance is to own gamma over outright volatility. As we discussed with the spot up, vol up dynamic, outright volatility pricing like simply buying VIX call options is distorted.
Right.
Owning gamma means buying options that increase in value exponentially during rapid, violent price swings. It provides a much cleaner, more responsive hedge against sudden mechanical unwinds than just betting on general market anxiety to remain high.
That makes perfect sense. Well, we have covered a tremendous amount of ground today, from the intricacies of dealer positioning to the geopolitical forces hijacking the yield curve. Let's distill this into the 3 core takeaways driving institutional positioning for the week ahead.
Let's do it.
First, we are witnessing a historic regime change in corporate capital allocation. S&P 500 cash spending is aggressively pivoting toward AI-driven capex, surging 38%. At the direct and deliberate expense of traditional share buybacks.
The second core takeaway is the bimodal holding pattern of the Federal Reserve. Rate cuts are definitively being pushed into late 2026. And this is not driven by domestic economic overheating, but by sticky, energy-driven core inflation that domestic monetary policy is largely powerless to resolve.
Finally, the jarring disconnect on the trading screens. The headline index all-time highs are actively masking severe structural fragility beneath the surface. The historic 8% high beta momentum unwind and the mechanical dealer gamma squeezes prove that this market is being supported by specialized derivatives plumbing rather than broad fundamental strength.
Which leaves us with a forward-looking macro puzzle to evaluate as you adjust your models for the week ahead.
What's that?
We've established that this unprecedented AI infrastructure build-out is currently masking a fragile economy. But if this massive CapEx cycle eventually yields the extraordinary labor productivity gains and automation that it promises, it will become an incredibly powerful deflationary force.
Right, because everything gets cheaper and more efficient.
Exactly. So the question becomes, could the current period of sticky, energy-driven inflation actually be the final violent gasp of the old macroeconomic regime?
Wow.
We may simply be enduring the friction of a transition state just before crossing the threshold into a permanently lower rate, highly deflationary era dictated entirely by artificial intelligence.
That is a profound thought to end on. Thank you for listening to Market Pulse by Orestes Capital. I'm Marcus, along with Elena. We'll be back on Monday with the latest market color and cross-asset analysis.